Hey everyone, Mike Gallo here, and it's another beautiful day in Port Richey, Florida. So today we're going to talk about ARMs, adjustable rate mortgages. What the heck is that? So what an adjustable rate mortgage is this cool little loan product that's specifically designed to give you a lower introductory interest rate. And then over time, your loan interest rate will then adjust based on the LIBOR scale of what the Fed interest rate is. So interest rates are going up. We know that. Now is a time where a lot of people may be looking into getting an ARM for their home purchase. You can lock in a lower interest rate for 5 or 7 years, maybe longer. And then at the end of that term, the interest rate will adjust based on what current market interest rates are doing. It's a good product if you're going to own the house for 3 to 5 years. If you're buying a house like an intermittent home, and you know that like in the next 3 to 5 years you're going to be moving, an ARM may be a good option for you. If you're purchasing a home to live in long term, an ARM may not be the way to go. 2 reasons. One, it's going to adjust, so your mortgage payment's going to fluctuate and most likely go up given the market that we're in now. The tricky thing with an ARM, an adjustable rate mortgage, is if you go into an ARM now and say, well, I'll just refinance in 3 to 5 years and lock in a 30-year fixed at a lower interest rate, that may or may not work for you. The home value may not be there. You may owe more than the current market value is. We saw it a lot in the mid to late 2000s. It was happening. So be cautious before you do an ARM. Really speak to your lender, have a conversation with your realtor, find out which loan product is really best for you. But if you are going to live in a house short term, 3 to 5 years, an ARM isn't a bad way to go. But if you think you might be in a house longer than that, I'd kind of shy away from that ARM and maybe go with a 30-year fix right off the bat, or maybe a 15-year fix, depending on the situation. So that was my tidbit about ARMs. They're becoming more popular as the interest rates go up. You're going to hear more people talking about adjustable rate mortgages, and they have a low introductory interest rate, which is great. But just remember that the housing crisis that we experienced in the late 2000s, a lot of it had to do with adjustable rate mortgages, and people's loans were adjusting to exorbitant amounts, and the property values weren't there because the market had cooled. So in a cooling market, you might want to be careful when you do an ARM, okay? If you do an ARM, my best advice would be to pay down that principal as much as possible, make more than your required monthly payment, your minimum payment as it were, pay more down on the principal so that you have less debt and more equity when the time comes that you may have to refinance the house. So that was my little tip. Before you get into an ARM, talk to your lender, talk to your realtor, make sure that your loan product is right for you and what you want to do in the future. You guys have a good one, and I'll catch you soon.